Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Okay, imagine this. You've got a massive tax bill staring you in the face, and you could just make it go away. Legally. Today, we're going to break down a really powerful strategy that global families use to do exactly that. We're talking about huge investment gains, relatives living overseas, and literally millions of dollars on the line. So that brings us to the big question, right? How can a gift, something you're giving away, actually end up saving you a fortune in taxes? I mean, it sounds completely backward, doesn't it? Well, the answer is pretty incredible, and it's all tucked away in a clever corner of the tax code. Let's dive in and see how it works.
All right, to really get the solution, we've got to start with the problem. And look, it's what you call a good problem to have, but it's a huge problem nonetheless. So let's picture this. We have a father, he's a US resident, and he had the incredible foresight to buy stock in a company like, say, Apple, way back in the day. Fast forward to today, and that stock is worth an absolute fortune. But here's the catch. If he decides to sell it, to cash in on that amazing investment, he's looking at a monster capital gains tax bill from Uncle Sam. So the real question becomes, how does he unlock all that value without handing over a massive chunk of it to the taxman?
And this is where the strategy gets really creative. What if he doesn't sell the stock at all? What if he just passes the torch to someone else in the family to handle the sale? This is where things start to get really interesting.
Okay, let's add one more crucial piece to the puzzle. His son is not a US resident. He lives in another country. So the father gifts this super valuable, highly appreciated stock to his son. Then the son turns around and sells it. Does that simple little move really let them sidestep that huge US tax bill? I mean, can you even do that? Is that legal? And the short answer is yes, it can absolutely work. Under the right set of circumstances, this strategy is totally legal and can be unbelievably effective. It all comes down to two very different but key principles of US tax law.
So you're probably wondering, how on earth is this possible? Well, it's not one single rule, but a combination of two completely separate parts of the US tax code that, when you put them together, create this amazing opportunity. So let's break down rule number one.
First up, we've got capital gains tax. This one's pretty simple, really. When you sell an asset, could be stock, real estate, a business, whatever, for more than you paid for it, the government wants its cut of that profit. That's the tax. Straightforward enough, right?
Okay, now this is where the magic really happens. Take a look at this. On the one hand, you have a US resident, like our dad. He gets taxed on his investment gains from anywhere in the world. But then on the other hand, you have a non-resident, like the son. And here's the kicker. He is generally not taxed by the US on gains from selling US stocks. This one little difference, that's the whole game right there. All right, so we've established that if the son sells, there's no US capital gains tax. Great. But wait a minute. What about the act of the father giving the stock to his son in the first place? That's what brings us to our second big rule, the US gift tax. This is a tax that's specifically designed to catch these huge transfers of wealth between people.
And that's the obvious next question, isn't it? You can't just give away millions of dollars of stock and expect the government to just look the other way, right? Surely they're going to want a piece of that gift itself. So what's the workaround for the gift tax?
Well, here's the thing. You don't get around it. You use the absolutely massive exemption that's built right into the tax code. For 2024, every single U.S. resident has a lifetime gift and estate tax exemption of, get this, $13.61 million. Just let that number sink in for a second. Our dad in this story can gift up to that entire amount over his lifetime without paying 1 red cent in U.S. gift tax.
Okay, so we have our two key puzzle pieces. One, non-residents generally don't pay U.S. capital gains tax on stock sales, and two, U.S. residents have this giant lifetime gift tax exemption. So now, let's put it all together and look at the actual playbook.
And here it is, the whole strategy in 3 simple steps. Step 1, the U.S. father gifts the stock to his non-resident son. He uses a piece of his lifetime exemption, so boom, no gift tax. Step 2, the son, living abroad, is now the official legal owner of that stock. And then Step 3, the son sells the stock, and because he's a non-resident, he pays $0 in U.S. capital gains tax.
And the result? It's incredibly powerful. The family has successfully taken all that massive growth in the stock, turned it into cash, and legally sidestepped the entire U.S. capital gains tax bill that the father would have been on the hook for.
Okay, I know what you're thinking. This sounds almost too good to be true, and while it is incredibly effective, I have to be really clear here. This is not a do-it-yourself weekend project. There are some huge potential landmines and critical details that you absolutely have to know about before you'd ever even dream of trying something like this.
So let's get into the all-important fine print. First, it doesn't just have to be a person-to-person gift. This can also work if the gift is made to a properly set up foreign trust. Second, this is not done in secret. The father absolutely must file a gift tax return with the IRS to report the whole thing. And third, and you really got to listen to this one because it's the most important point of all, everything we've talked about so far only looks at U.S. law.
And that brings us to the single most critical warning. You could execute a plan that is absolutely brilliant for U.S. tax purposes. But what happens when the son actually receives that gift or sells that stock in his home country? His country's tax laws could take your brilliant plan and turn it into an absolute financial disaster on his end.
So what's the bottom line here? The takeaway is pretty clear. This gifting loophole can be an amazing tool for families spread across the globe, but it is not simple. It demands a totally comprehensive, multinational strategy. It's not just about solving the U.S. tax problem. It's about making sure that solution doesn't create a bigger problem somewhere else. So the final question is your plan really considering all the angles? Because that's the real multi-million-dollar question.